in terms of dividends, you get into an expectational situation. And for most companies that that pay a cash dividend, it doesn't make sense to bounce around the dividend from year to year, although private companies frequently do that. And we do it ourselves with our subsidiaries. Some subsidiary can pay us a lot of money one year and not so much money the next year. But with public companies, a lot of people do buy stocks to obtain dividends, and they hope for regularity, and there's a signaling aspect to it and everything. So I would say that once you establish a dividend policy with a public company, you should think a long time before you change that policy in a material way. Charlie?
Yeah, dividends are a very interesting subject. If you count the unnecessary stock trading and the cost of investment advice and the cost of making a lot of errors and the trading costs in and out, I don't think it would be too extreme to say that now the total amount that's paid out in dividends is roughly equal to the amount that is wasted in all this trading and investment advice. So that the net dividends that come to the shareholders are approximately zero. This is a very peculiar way to run a republic, and very few people comment about it.
Yeah, actually, I did in an article some time ago in Fortune. The frictional costs to American shareholders in sort of changing shares for all American business as a whole, those frictional costs are probably not much different than the entire amount paid out by American corporations. So, but getting to the individual corporation level, a company that expects to regularly earn more than it can profitably employ in its business should be paying out dividends. Take a subsidiary of ours like See's Candy. We would love to expand See's Candy to double or triple its present size, but it doesn't work. We've tried it a lot of different ways. So it should be paying out its earnings. If it was a public company, and it was at one time, you could argue that something approaching a 100% payout would make sense there. But most management's worrying about earnings falling off at some time in the future would rather establish a lower level and therefore ensure regularity of dividends by going with a conservative level. It's obviously something we think about at Berkshire when we have $30-odd billion around. If we can't figure out a way to employ that over time, it's a mistake to keep it in corporate form. But we have this expectation, and I think it's a reasonable expectation, that we get to put it to work. If we ever came to the different conclusion, if we thought our stock was significantly undervalued, we'd probably figure in terms of dispersing it through repurchases, particularly where now dividends and capital gains are neutral for individuals. If our stock was not underpriced and we fell, we would probably do something via a dividend.
All right, guys, now let's get into the 3 ETFs that should be on your watch list at this time. And for those joining us for the first time, this is the Nick Finance Clips channel, where we talk about ETFs and safe investments following principles learned from Warren Buffett. I highly recommend that you check out some of the other videos on this channel to learn how he thinks and some of the lessons I have learned from him. Now, with that said, let's get into the first ETF on today's list, which is ticker DVY. That's the iShares Select Dividend ETFs. You on this channel know very well that I love to see how the ETF itself have performed, which is why the first thing to check out is the 10-year performance, which is 120.29%. That's great. The 5-year performance comes in at 34.68%, which is also somewhat commendable. Now, guys, this ETF pays a yield of 3.08%, which is not so bad, and the assets under management stand at 20.6 billion. The ETF has an expense ratio of 0.38%, which is higher than what we would see with Vanguard and some other ETFs, but again, that is exactly what it is. One important thing I always love to check about any ETF I analyze on this channel is how the dividends have grown over the past 5 years. And in this ETF, we see a 7.25% growth rate, which is highly commendable in my personal opinion. Now, one other thing I always look at is the holding breakdown. And you see that this ETF is basically exposed to somewhat stable sectors, with utility accounting for 26.06%, Financials account for nearly 24%, and energy accounting for 10%, which leads us to the names in this ETF like ExxonMobil, Chevron Corporation, Pfizer, AT&T, First Energy. So the top 10 holdings are basically in this kind of safer industry categorizations. Now, I must also add that in screening for stocks in this ETF, the managers took some things into consideration. Check this out. It takes a more qualitative approach by screening for high yield dividend stocks that have paid 5 years or more consistently to shareholders. So these are companies that have a good track record of paying dividends consistently to investors. Now, with all that's going on around the world, nobody can fault diversification. So the second ETF on this list is ticker VYMI, which is the Vanguard International High Dividend Yield ETF. This ETF has not recorded a stellar performance, with a 10-year performance at just 22.12%. Over the last 5 years, guys, this ETF has returned a paltry 7%. But here's the catch with this ETF, guys. The yield is 4.45%, and it's quite a small ETF at 3.57 billion. Okay. Now, the expense ratio comes in at 0.22%, which is lower than what we saw with the previous one at 0.38%. But guys, this ETF came on the list because number one, it takes the whole world into consideration and not just United States. I think at this time, I prefer to look at more diversification plays relative to concentration plays, just to have that safety in your portfolio. Now, the 5-year growth rate of dividend in this ETF is staggering at 16.31%, which shows that this ETF is bullish on growing its dividends, but have not really enjoyed that kind of capital appreciation like we saw with the previous ETF. Now, checking out the holding breakdown, the ETF is heavily weighted to financials at a whopping 32%. Energy comes in second at nearly 10%, while basic materials comes in at 9%. So you would not be surprised to see different stocks in different geographies playing out here, like Nestle, Toyota, Roche, Shell, all sorts of companies, Royal Bank of Canada, BHP Group, Toronto Dominion Bank, HSBC Holding. So when you think of a diversification play in the real sense of it, that is what this ETF brings to bear. Again, the ETF has not done well in terms of capital appreciation, but with respect to dividends and growing its dividends, this is the number one ETF on my watch list. And to get more specific, check this out. Some 1,200 stocks make up this fund, including familiar names such as Swiss consumer products giant Nestle and Japanese automaker Toyota, like I showed you guys before. So we're looking at thousands of companies across the world, which will really give that diversification and give us dividends over the long term. Now, before we get into the third ETF on this list, I need you to bear in mind that this is not financial advice. I'm just sharing my personal opinions and showing you what is on my watch list, which you might add to yours as well. Now, the third ETF on the list is HDV, which is the iShares Core High Yield Dividend ETF, which has seen an 81.98% growth over the last 10 years and a 5-year performance of 22.72%. The ETF is also quite small at 8.5 billion assets under management, but has a yield of 3.36% and a very sweet low expense ratio of 0.08%. From a growth standpoint, the ETF has grown its dividends by 5.38% over the last 5 years, which is about the slowest growth we can see compared to the other two that we've discussed earlier. Now, when you talk about safety, this is really the ETF that holds that safety card to the highest point. Now, its exposure is really in healthcare at 24%, energy at 20%, and consumer defensive at 18%, with names like ExxonMobil, Chevron, AbbVie, Philip Morris, Pfizer, Coca-Cola, Merck coming in tops in this ETF. One of the reasons why I looked at this ETF at all is the fact that it has a defensive nature. Check this out. HDV is built for defensive investors looking to take some risk off the table without disrupting their high dividend income streams. All right. So that's the whole essence, to have a defensive play in the mix of ETFs that I have in my personal portfolio. Now, in addition to these 3 ETFs I've mentioned, I would advise that you check out this particular video on the top 3 dividend ETFs for high dividend yields. Now, these ones have a much safer profile and a lower dividend yield compared to the ones we have discussed today, but it's always good to have a mix of different ETFs so the best choices can be made. So just as a final reminder, if you haven't done so already and you like what you heard in this channel, subscribe to the channel, like the video, and join us on our journey to financial freedom. Thank you so much for watching, guys, and hopefully I'll see you all again in the very next video. Cheers.